Welcome to the October 2025 edition of the Agricultural Market Situation Outlook webinar. My name is Dave Ripplinger, moderator, organizer of the event. As always, we'll have a series of presentations with Q&A at the end. Feel free to use either the Q&A tool or the chat. But with that, we'll go ahead and kick it over to Brian.
So I was going to do some reports on some macro stuff like unemployment, inflation, things like that. But with the government shutdown, unfortunately, none of those reports are coming out right now. So as a result, I had to kind of adjust what the plan was. What I want to talk about today are some of the reports and just highlight some of the graphics that came out of these two Federal Reserve Branch reports related to agriculture. There's three or four Federal Reserves that do a lot of agricultural research. Kansas City Fed's probably the biggest, and then the Minneapolis Fed does some work as well, and I'll cover that. But I wanted to give credit and citation for the reports that I'm referencing in this presentation. All right, so first of all, when I go through some of these, they basically ask, they say at agricultural banks versus non-ag banks. And what is an ag bank? Well, at least according to these folks, they have a total agricultural loans comprising at least 25% of their total loan volume. So at least a quarter of it. Now, some may have much more, but you have to have at least 25% to be considered an ag bank. And the graphics from the KC Fed use the same group through all the years of 931 ag banks in every year shown. All right, so changes in farm debt outstanding. So with some of the weakness in the ag economy, it's interesting and worthwhile to look at, are there softening? Is there some weakness showing up on the lender side in terms of performance of their portfolios, loans, things going forward? And so the first graphic, I think could be a bit misleading. So you see percent change on real estate debt, for instance, on agricultural banks, okay, versus non-ag banks. You see real estate debt went down significantly on non-ag banks and then went up on agricultural banks. And the percent change from the previous year basically stayed flat here but went down. One of the things that's happened in agricultural lending, and I'm sure any of the lenders who are on listening to this can attest, some of our big commercial banks are basically divesting from agriculture or doing less loans and things like that for agriculture. And then, of course, agricultural banks are the ones who are picking up that slack. So increases in real estate debt for ag banks versus non-ag banks could simply be a function of their divesting, while in agricultural banks are picking up those extra portfolios on the side. But we'll see going forward how that's looking. And you see what you have. This kind of illustrates it. Real estate loans in billions of dollars, they're below the non-agricultural banks are comfortably below the 20-year average, whereas ag banks have been steady increasing and are a good 45% above now. Non-agricultural banks still have, in terms of billions of dollars adjusted for 2025, a large share of the real estate portfolio. But on the non-real estate side, in terms of like operating loans and things like that, or equipment loans, and I actually think that, yeah, that this is basically going to reverse, and all of a sudden, ag banks are going to overtake non-ag banks in this category. And the one thing I'll say about on the real estate side, it takes a lot longer for a non-ag, for any bank for that matter, to divest its real estate portfolio rather than, for instance, operating lines and something like that. Because obviously a real estate loans, those are much longer, 20, 25 years. Operating loans or other, chattel type loans, those are much shorter term, so they turn over faster. So getting out of that doesn't take nearly as long as it does on the real estate side. But nonetheless, it appears that both are happening, that the non-ag banks are divesting from real estate while the ag banks are picking up that slack. And then non-real estate loans, that's been happening for a while. And not in the not so distant future, I am thinking that ag banks are going to take over non-real estate loan volume as being the biggest. But this is a bit on the concerning side when we talk about the liquidity issues. So our earnings ratios have been trending up over the last, and this is from the bank's perspective, have been trending up over the last few years, primarily because of more loans being taken out, okay, and higher interest rates. All right, so net interest margin on the left axis has gone up. It kind of bottomed out there at 3%, and it's now approaching 3.5%. And then return on average assets, which you see here on the right, has went from around 1.1 to about 1.3%. And while net interest margin is still below the 20-year average, you also have to note that the 20-year average includes 2020 or 2005, 2006 when interest rates, all the way through 2009, interest rates were much higher back then, and as a result, that kind of brought that average up. But it's approaching it. And the other part of it is that's kind of keeping this average down are all those loans that were taken out, in the late 20 teens, and then here those interest rates were really low, and if they're locked in, if they're fixed, then they're staying low. But this loan to deposit ratio is really growing in the last few years, and it's above the 20-year average. So the higher this ratio is, the less liquidity there is in the market, right? Because that means relative to the number of deposits that are sitting in any bank account, and this is on ag banks, there's more loans going out. So there's less loanable funds in the system than there was 2 or 3 years ago, showing that farmers and producers are needing to borrow more money to operate, things like that, and that working capital is likely declining and has been declining since 2022. And that loan to deposit, it's not the highest it's been. That was, 2018 or so, 2019 when it was approaching 85%, but it's getting close to 80 right now. So distribution of farm debt growth. Okay, so which is it just a few banks that this is happening to, or is it, across the board? If we look at the median, the increase in debt at the median is about 5% of banks. Okay. Whereas the 75th percentile, so 25% or so are having a growth in farm debt of 10%. And then the 25th percentile, so the bottom quarter really saw no growth. So you have a range here of anywhere between 0% up to 11% growth in ag debt at ag banks. Then finally, from the KC Fed, the last thing, farm delinquency, loan delinquency rates. Okay, so those have been increasing for the last 2 years, but we're starting from a very low number. All right, so they almost effectively doubled, but we started at 1%, and if it does double, then we're at 2%. And you go back to 2010 at like non-agricultural banks, this was closer to 3.5, and even at ag banks, 1.7% or so, and then kind of peaked up again in 2019 up to 2%. We're still not there yet, but you can see the trend has reversed from that really strong showing in 2021 and 22. And then that distribution of delinquency. Uh, what it shows here, though, is that the delinquencies are kind of concentrated in this 25% group because the 40th percentile is at almost is basically zero. The median is very close to zero, but there's a group of lenders, and I don't know what the details are on who comprises that group, if there's an identifying characteristic in that specific group that's showing so much more than the rest, but that does show that a quarter of the banks really have almost all the delinquencies, just this 25% group. And again, I don't know, they don't detail out what that lender profile looks like or what that borrower profile in that looks like. Maybe it's a group who lends a lot to one particular production system or crop type. That I don't know, but it does warrant investigation for sure. Now, quickly shifting to our own Federal Reserve District, which is the ninth out of Minneapolis, and that services Wisconsin, Minnesota, North Dakota, South Dakota, Montana, uh, and I believe that's the significant share of it. Cash holdings by farms subdued relative to debt, and what you see is the blue line is, or the teal kind of line, is the amount of dollars in debt with across the district. And then you see this blue line is the working capital line. And the amount of debt increase is increasing faster than the working capital. Okay. And these are in deflated 2025 dollars. So you look at the amount of working capital in 2012. Okay. It was, adjusted for inflation over 200 billion. The amount of working capital in 2024 is significantly less than that. And yet the amount of debt adjusted for inflation continues to rise. Okay. So our working capital to debt ratio is worse today than it was 13 years ago. And it's really worse today than the entire period on the graph that you see here. And that includes some fairly tough times in like 2019 and 2018. So another thing to consider there. And of course, a lot of the reason is if you look at the crops prices received across our district, corn's averaging around $5 a bushel, wheat's averaging around $5 a bushel, and soybeans around 10. Wheat, that would make it basically below our estimated break even with our NDSU budgets. Corn would be that'd be a little bit above break even, and soybeans a bit above break even. But the point still stands that commodity prices coupled with high production costs are why we're seeing a lot of this economic weakness across all of agriculture and some significant signs at agricultural lenders that there are some issues out there, some very big ones. Last thing I want to show is that this comes from the Minneapolis Fed. It's a survey that they do every quarter, and they ask about things that have increased or decreased. In this case, it's percentage of respondents, and they're questioning lenders in this survey. So it's not producers, it's lenders that are being surveyed. And it's the percent of respondents who expect decreased levels for the next 3 months. Decreased levels, the first category is rate of loan repayment. If you see a line here, there weren't enough responses to actually generate a report for that state. But North Dakota has the highest across the district in the largest decrease in loan repayments. North Dakota has some of the highest reduction in net farm income. Unfortunately for Wisconsin, that title goes to them, that 100% are saying lower net farm incomes. A lot of that's because of the composition of what's raised there. For instance, Montana's a lot more livestock, and South Dakota is a significant share of livestock. So you're gonna if you're a primary cow calf or beef cattle producer, you won't have seen a decrease over the last few years, more than likely. But states that are primarily crop, or if they are livestock, dairy, high rates of independent dairy, I'm talking about, decrease. Farm household spending decreases. North Dakotan farmers have certainly decreased their spending, the highest rate of all of the district. And then decreases in capital spending, equipment purchases, new buildings, things like that. Pretty much universally across the district, a pretty high rate of them decreasing that capital spending. And then this next part is on increases, and North Dakota has by a wide margin the highest increase in loan renewals or extensions, or percentage of respondents reporting that. And then as far as increases in loan demand, 75% of North Dakotans bankers are saying, yep, we're seeing higher loan demand, and Wisconsin again takes the award for the almost pretty much all of the people they surveyed saying, yep, more loan demand across the board. So here are the sources if you wanted to read those actual reports yourself. There's some good information in there if you're trying to dig into the weeds and sort of read some of these tea leaves yourself on the performance of the general ag economy. If you don't want to mess with these links, that's fine. You can just Google agriculture Minneapolis Reserve, or Google agriculture Kansas City Federal Reserve, and they're pretty easy to find. They'll be the first things you pop up, and there's a series of reports, and I encourage you to go in there and read them when you got some spare time. There's good information. They have good economists that work at those places, and I use a lot of their information for some of the stuff I do. So uh, I guess to wrap things up with a bow, significant weakness showing in the ag economy, and if you look in the right place, you can find it. But we are, as far as bankruptcies go, which is always the one that draws the most attention, that's still on a very low. That's still infrequent, I guess, is what I would say right now. We're starting from a low number, but we don't want to get to a big one, and because that's really the final straw, and that's when things really take a turn. All right, so with that, I am turning this over to the um, bringer of great news, Frayne Olson. At least so everyone hopes.
Good afternoon, everybody. Frayne Olson. I'm a crop economist, marketing specialist here at NDSU. We're going to talk about the grain markets and the lack of USDA reports. Key market movers. First off, the WASDE report, as well as the production report, which are the monthly updates that USDA provides us, were not released today. They were supposed to be released at 11 o'clock. That saved me a whole bunch of time to try and update my slides at the last second. So, in one level, this has been helpful to me because I haven't had to rush so badly. But on the other side, it's like, okay, what do I talk about? The other part of this is that there's other basically all the USDA reports, including the weekly export sales numbers, the crop progress reports. There seems like there's a couple reports coming out from USDA almost every day. All of this stuff has screeched to a halt. So that's also being stopped due to the shutdown. Now, when the government cranks back up again, some of these may go back and be reported retroactively. Most of them will not. Because the data has not been collected, it's not going to be reported. However, we still have some industry estimates that are hitting the marketplace. And so again, it's still we have some guidance, we have some reference points. It's just not that those point estimates or those specific numbers that the USDA usually tries to report for us. So let's go through. I updated these slides based off the surveys that were done of private analysts and traders. So again, there's a lot of the companies that the big grain handling companies and processing companies, as well as some of the private analytical firms, put together their own forecasts, and they try and estimate or predict not only what they think, but also what they think USDA will release. So what I've tried to summarize here, this is the same basic table I've shown for basically since we started the series, is the average. So the top line in blue is the average trade estimate, and it gives the highest estimate and the lowest estimate for each one of these components. Towards the bottom, and the highlighted in black, is last month's numbers, and of course, we didn't get any new information today. But let's look at what the trade is expecting. Basically, they're revealing some of their beliefs about the numbers that USDA would have released versus what we had last year, or last month, excuse me. I think we can gain some insights into that, and I do want to point out a couple things. So first, let's look at the corn column under production. The average trade estimate is down a bit, and if you notice, most of that is coming in a reduction of yield. Now, and we're still getting a lot of kind of conflicting answers and reports on what's happening with the yield projections coming out during harvest now as harvest begins. But the general expectation is when farmers get into it, they're still having a great year, just not quite the huge numbers we saw earlier. Okay, so the trade is basically trading on, or when you look at the futures market, I think has more of a 16.6 million metric ton, 16.6 billion bushel number versus the 16.8 that came out in September. Now, I just want to remind everybody that even if you look at the lowest trade estimate at 16.45 billion bushels, that's still more than a billion bushels higher than our previous record. Our previous record was 15.3. And the lowest estimate we're looking at now is 16.45 with an average of 16.6. So please remember and understand, regardless of what happens from this point forward, we are going to have a record corn crop by a long ways. I mean, a billion bushel more than our previous record. Okay, I just want to put that in perspective for everybody. All right, let's shift over to soybeans. When you look at the total production estimate for soybeans, it's down just a tiny bit from what the USDA number was reported in September. But we have a pretty wide range. And I just want to also comment back on the corn. If you look at the difference between the high and the low, there's pretty wide range there still in the marketplace on differences in expectations. Same thing on soybeans. The trade is expecting the average soybean yield to come down just a little bit. It's still a very, very strong number. Now, 14.2 2 or 14.3 billion bushels is not a record for soybeans, but it's definitely in the top 2 or 3 or 4, I guess. I'd have to go back and look specifically. So very, very good soybean crop. We're blowing the top off the corn crop. Now, we did get at the end of September, just before the government shut down on October 1, we did get the September grain stocks report. The reason that's important is that red line on the bottom. That is the kind of that final official number that USDA took for inventory. So how much is left in the inventory just before harvest? And that's both commercial storage at the grain elevator, at an ethanol plant, at a feed mill, or on farm. Now, the blue line above it is what USDA was forecasting that number would be as of the September report. So when you start comparing those, it looks like, based on the earlier forecasts of USDA, it looks like they might have been a little bit too shy. They might have been a little bit too small. We actually had more corn in the bin before harvest started than we had expected. Looking over at the soybeans, it's kind of the opposite. The inventories on soybeans came up a little smaller than what USDA was forecasting based on the September forecast or estimate. So when we do get some updates, hopefully now in the November WASDE report, these numbers in highlighted in red will become the ending stocks from last year. So there will be several adjustments made, not only for old crop, but more importantly, new crop as we move forward. So I know that's some technical detail things, but please just understand that we're looking at a little bit more corn from last year we're carrying forward than we had expected, and a little bit less soybeans. So what about ending stocks? So how much do we think we're going to have, basically this time next year? And the reason this is important is because that number is an indication of how much work does the pricing system have to do to be able to ration out or basically come up with an ending stocks number that's reasonable. So the blue line on top again is the average trade estimates. We have the highest and lowest reported, and the black line towards the bottom that's highlighted is what we got in September last month. So the average trade estimate is we're going to see a little bit more wheat inventory for new crop, the crop we just got done harvesting. And a lot of that because of, again, the September small grains report. So the small grains report, as well as the ending stock, or the grain stocks report, came out on the same day. So we just snuck that in before the shutdown. And we did have slightly better production on wheat, not only winter wheat, but spring wheat, than was first expected. Okay, so some of that's going to end up in our bottom line for carryover stocks in wheat. On the corn side, again, what the traders are doing is they're taking the information from that grain stocks report, as well as their own estimates of what total production will be, and they're going through their own math. And it looks as though they're expecting the corn inventories to increase just a little bit. Again, some of that from inventory from last year, as well as a slight decrease in the production from this year. For soybeans, basically no net change. So even though we're bringing in a little bit less from last year, I think there's still some concerns about exports and export pace, and whether that will really end up being and matching the current USDA forecast out of the September report. I want to give you an update, and I guess these are just sets of questions that I've been getting now, not only in the press, but I also did the Ag By to the Numbers article on it this last month. I've showed you this table before. I want to explain it very quickly, and then I want to dive into some new numbers. So the 4 columns on the left-hand side, so it'd be these 4 columns over here, are 12-month totals. So we're looking back in history at each of the major marketing years and saying, how much soybean did we export to each of these countries? On the far right-hand side, that's the year-to-date totals, and I did update them for the most recent information. Now, last week, we did not get an update to these numbers, so we're already about a week, almost 2 weeks behind, but it does give us a reference point. So if we look at our largest soybean buyer, historically, you can see that their purchases from the U.S. have been going down. Obviously, in the news a lot is the fact that officially China has not bought any U.S. soybeans yet. When we look at Mexico, the Mexican numbers are relatively stable. We look at how much have we sold this year versus the same time last year. They are a little bit of ahead. Same with Egypt, a little bit ahead of last year's pace. Indonesia, about the same pace. Japan, about the same. Spain, a little bit up, but Germany hasn't bought anything this year. So far this year. So if we look at total, how much have we total sold for new crop? Now the crop that we're harvesting right now, we're down pretty significantly. So here's the question that I always get. Well, if China doesn't buy anything from us and they're buying everything from either Brazil or Argentina or Paraguay or Uruguay or Canada, if all those beans are going into China, that should open up some markets for us, right? Well, yeah, we should. The challenge we're going to have, though, is that a lot of the countries that we may be able to sell more to are relatively small. So the other challenge we have with soybeans is you need to sell soybeans to a country that has crushing capacity, because we don't use whole soy. I mean, corn, we can use whole corn, but whole soy you have to process first. So that really starts limiting the number of countries that we can start shipping soybeans to. So let's look at that first. Which countries around the world have crush capacity? Again, these are all USDA numbers. They update them every month. And I do give some historical background. This column on the far right-hand side is the current, most recent September numbers for 2025. So that'd be the new crop numbers. So this 24-25 right here, which I'm going to probably focus on the most, is last year's marketing year. So as you can see, China is the number one soybean crusher in the world. Okay. But the U.S. is number two. We're kind of a distant number two, but we are number two. And then we get to Brazil and Argentina. Well, okay. So if we add up those numbers, we take the crush capacity in China, the United States, Brazil, and Argentina, and we divide by the total crush capacity globally, those top four countries account for 75% of all the crush capacity we have in the globe. Okay, so if we don't sell to China, we're already crushing all the beans we possibly can. And I don't think we're going to take U.S. soybeans and sell them into Brazil or Argentina for them to crush them. That means that 75% of the global market is already off base or off the shelf. Okay, so who can we sell to? Well, first you have to have crush capacity. And again, the European Union is number 5, but it's at 15 billion bushels. 15 million metric tons. So let me go back one. Last year, we sold 22.5 million metric ton to China. That's how much we as the U.S. sold to China, 22.5. Well, the entire crush capacity in Europe is 15. And then we get to India, which is 11. Okay, then we go to Mexico, Russia, Egypt, and Thailand. Now, there's a whole bunch of countries. If you look at this ROW, which is the rest of the world, there are a lot of countries that have a little bit of crushing capacity. Okay, so here's part of my story. Part one of my story is, okay, first we have to find countries that have crushing capacity that are looking for soybeans. Okay, the second question is, well, of those countries that have crushing capacity, well, they can grow some of their own soybeans and crush some of their own soybeans. So how many of those countries actually import soybeans for their crushing sector, which is this table? And you can see China is the largest importer of soybeans. Okay, and then I'm going to talk about this 2024-25 number in just a second. But you can see that number has been increasing. European Union is the second largest importer of whole soybeans, and then Argentina. Now, Argentina actually imports some from Brazil, so because of the size of their crushing capacity or crushing sector industry. Then you get Mexico, Egypt, Thailand, Turkey, Japan. So those are the top candidates. And you can see again, as we move down the list, those numbers become pretty small pretty quickly. So let's look at last year's totals. This is 24-25. This is old crop from last year. The percentage I have on the far right-hand side is So of all the soybeans, for example, that China purchased, how much came from the US? So what's the US percentage or portion of their total imports? Well, in China, it's about 21%. So when we think about the size of the market and what are we currently supplying and how much growth capacity is there? Okay, well, if we eliminate this 22.5 million metric ton that we have been sending to China last year, if that goes to zero and stays at zero, I think it's not likely that that'll happen, but it is possible. Okay, who do we sell to? Well, in the European Union, yeah, they import 14.6 million metric ton, but we're already supplying 40% of that. As I said earlier, I look back historically, we do not send any soybeans into Argentina to be crushed. For Mexico, 6.4 million metric ton, pretty significant number, but we're already supplying 77% of that. At least that was last year's numbers. For Egypt, 4.5 million metric ton. We're already supplying 82% of their needs. Then go to Thailand, we're about 11%. So there's some growth opportunities there. Turkey, we're about 20% of their current imports. So there's some growth opportunities there. And then you get Japan at 62%. So what I'm trying to think about here is we do have some countries that have the capacity to buy more US soy, that we can kind of backfill some of the supplies that other countries that they have probably been buying from Brazil. My challenge with that, my concern with that is these are relatively small countries. We're already, in many cases, supplying a large percentage of their total needs. And they usually want smaller shipments. So they don't need the big volumes. They don't need to have, 20 Panamax vessels ordered in a month to be able to supply their needs. They're looking at much smaller volumes over a more steady pace, over more steady time. So one of the challenges that I have, and I've been thinking a lot about, is we need in the US to try and meet these needs, we're going to have to rethink our supply chains and how we're managing our customer base. I want to be very clear. I think there's some growth opportunities in a lot of these countries, but we have to recognize that they're not going to want or request these very large shipments. So we have to be a little bit concerned about how the pace of exports, that we need to be regular customers, that we need to be supplying a little bit every month instead of these big blocks and big chunks like we've been sending to China. So it raises some questions about storage capacity, about the ability of the market to try and spread these sales out a little bit more over time. Okay, so and that's my last slide. So I'm going to stop sharing here. Hang on a minute. Stop sharing. And just want to conclude with a couple thoughts that, we have that capacity, but we have to adjust our thinking and our system to be able to accommodate some of these smaller crushing sectors and the countries with the smaller capacities. So with that, I'll hand things over to Tim.
Good afternoon, everybody. Tim Petrie, again, going to give you just a kind of a quick update on the cattle situation and start off with Fed steers. And right away, I'm going to start off, Frayne started off with USDA. USDA Agricultural Marketing Service is still reporting prices at markets. So we still have those. And thankfully, LRP is still being sold. So, in that case, I have stuff to talk about. And information coming in. Yeah, we don't have the WSDA report today that gave us the big overall picture and their forecasts for prices for this year and so on, but we're still got a lot we can talk about. So start off with Fed steers. And again, I've been showing you this all year and we've been marching up. There is concern, however, by some people at least, that the Fed cattle market has fallen off since, about the middle of August 18th to 22nd that week. We were all-time record highs up there. And at 244.25, I think it is, and we've fallen off to last week to about 231. So we're down about $13 there. But that is a very normal thing, you know, and it's related a lot to the cutout. I didn't bring the cutout slide of what packers can sell meat for, but or beef for, but you know that's why fed cattle are going down, because the wholesale market there is going down, but a very normal seasonal thing, you know, during the barbecue season, and you know, going back to Labor Day kind of finishes that up, and after Labor Day we're turning to fall, start thinking about Thanksgiving and so on, and the cutout value goes down, and so the cutout value has been going down. And I know the media is kind of hyping, okay, is this the all-time cyclical peak? Are we down down from here, and have prices finally got so high enough that consumers are backing off on all that? And at the present time, it does not look like that. Yeah, we went down about $13, but last year seasonally we went down $15 before we started coming up, and so you know, kind of a normal situation there. The cutout value this week is increasing. We were last Friday down, I think, about you know, $6-7 lower than, you know, it's been going up this week. So there is a turnaround in the cutout value. And really, hardly any fed cattle have sold this week, but that should put a floor there. But you know, the cutout value is going up, which is good news, which means that we are buying beef again. And the seasonal pattern for fed cattle, as you can see there on the right-hand side of the chart, is after you know, get the Thanksgiving out of the way, and again, the buying for Thanksgiving occurs before Thanksgiving, so it could get on the market. So a little before Thanksgiving, our market, the cutout usually picks up, and it did pick up this week as the holiday buying, the prime rib season, holiday festivity season starts, and it picks back up. And the red line there again is this year. Those red squares there are the futures market. And the futures market, this is yesterday's close. The nearby futures today went up about $1 on fed cattle, so they'd be just a little higher than that. And then the further out ones into next year actually went up a couple dollars. They're getting a little bit more optimistic for next year. So anyway, I know there was some concern, and I'm just trying to, you know, kind of put a squash on that for now. And, you know, we didn't have a WASDE report. The last WASDE report came out. USDA was predicting 248.50 on fed steers next year, and that's higher than the futures market are indicating, at least on this chart, and actually higher than possibly I think they might be, because USDA, when they put out their forecast, they have to assume everything is the same. So that means, you know, Brazil is still closed to beef, and there's no Mexican cattle coming in, and trade is the same, and all that. But anyway, the futures market still is indicating, you know, about a 235 or so average for next year on fed steers, which would be higher than the 228 this year. So, you know, that's kind of the story there. We'll see what fed cattle trade at here the rest of the week, but at least the cutout is going up, and there still are big losses at the packer level, however. And again, the two biggest things that affect feeder cattle are fed cattle prices and corn prices. So you know, the futures were up today, and the cutout's turning around. So we'll mention that again when we get to feeder cattle. So go to the calf prices now. And again, like I've been saying all year, they've just been marching up at record levels. But again, they kind of leveled out there and fell off this week or last week. And again, some concern in the media, but again, a very normal thing. And sometimes even last year they went down earlier than now because it was so dry down in the southern plains, and calves left early and so on. But you know, I expect continued. We're selling, particularly in North Dakota, but in much of the northern plains and all the way down, calf runs are very, very light. They're just now starting. man, in North Dakota, we've got in most places a lot of grass, and the weather's been nice, and there's still harvest going on, and even hay being made that didn't get made during the summer when it was too wet and so on. And so very little calf movement, but they're going to pick up now in the next couple of weeks on the federal grazing. Now the cattle have to come off from that and so on. So, but I do expect seasonal week. We're up there about 427 last week, and they're well supported for this time of the year, record high prices above last year, and I think good support at the 390 to $4 range in there. And I keep saying this all the time, but we look at one price on this chart as the average price, but there's always a wide range in calf prices. Be a $40 range for 556 weight steers when the big runs start hitting the market here in a month or so. And kind of, I think maybe I'll get to this when I get to the backgrounding slide, but there is talk about, are a lot of more calves going to move to market this year because the prices are high, and so might as well sell them and so on. But I think from a marketing standpoint, many producers at least are going to stick with their the same marketing plan they have been. If they sell in November, likely do that. But we have moved from November being the big marketing months to January is our biggest month, and for good reason, because the calves bring more money in January because they've been weaned and are bunk trained and shots and so on and so on and so on. And so we've moved to January. And so I think for that reason, calves will be sold in January, because if they sell them this year, you get two pretty good priced calf crops in the same year to pay income taxes on. And so, so I think we'll do normal that way. But anyway, calf prices I say quite often, when the fundamentals are good, they seem to all be good. And when the fundamentals are bad in the cattle business, they all seem to be bad. And so listed there are the many things that are affecting calf prices that are that are positive. There, strong fed cattle prices, and again the cutout run out this week, and fed cattle futures are up $1 to $2 today, and it still at record high levels for this time of the year. We've got a short supply, the lowest calf crop to sell for many years. The Mexican border is closed now, so we're getting 20 to 25,000 less calves in to go on winter wheat in the southern plains, and the winter wheat crop is good compared to last year when it was so dry at this time down there, and the winter wheat conditions are very good. We have heifer retention, new feedlot capacity, a big 150,000 head feedlot in southwestern Nebraska is being built, and they're going to even add on now already to that up to 200,000. So we've got a lot of feedlot capacity and a demand for calves there. And then, Frayne talked about the low corn prices. So all those things together, and calf prices have done very well. But again, I fully expect to see some seasonal weakness, but be well supported at the record high levels there. Go to the heavyweight yearling cattle, and the same story there. They just been inching up throughout the year for the same reasons that I really talked about before. And Frayne and I were just talking about it before we came on here. My futures market prices here are yesterday's close, because I didn't have time to update them, but they're up. Most of them are up over $5 today, and we'll see the chart in a minute for the October futures is up 450, and so you can add on to that. And so and we do run a positive basis on our 750 to 8 weight over the futures price as well. So again, compared to last year, we're well supported at record high levels and so on. But I think again, there's going to be some seasonal weakness occurring as usual that happens this time of the year when the big runs of the yearlings are coming to market now, and then when the calves come to market and so on. But there's the futures market for next year, and you can add today $5 on to those. So January's up to 369 and March up to 365.42 and so on. So, just the short supply and excess feedlot capacity and like Frank said, a good corn crop in Nebraska. They like to put in high moisture corn and get it into the bunker, and then there's only thing they can do with it is feed cattle with it. So that all supports the calf market. So here's the October feeder cattle futures. And again, lately we have seen a lot of volatility there. When I ran this chart just an hour ago, the October futures were at 373.90, but they ended up closing at 374.02, up 450. And so just all-time record contract highs again, and getting above the green line there is the cash settlement price at the last Thursday in October here. The two do have to come together, the cash index, because that's what the futures market gets closed out at. And so, just a lot of optimism there, but volatility coming along. Just go back to at the beginning of October there. On October 1st there, we had a big crash in the market because a vaccine was released to help with screwworm. And so there was this big rumor, okay, USDA is opening up the border in November and there'll be cattle coming in and all that. And, that was not the case at all. And, several weeks before that, there was an announcement that the Secretary of Ag was heading to Texas to make a speech. And so the same thing, the news media interpret that as they're going to open up the border. And, actually she was just going, and that's her going home for the weekend and making a speech and so on. So there's a lot of volatility there whenever some of those announcements about screwworm or something comes out. But, anyway, just record high futures, which, when we look at some price risk management, just offers higher and higher possibilities there. So, like I kind of mentioned to begin with, there's the big question now, are producers going to background cattle this year? And at these very, very high, all-time record high calf prices, is there any potential for backgrounding? And the answer to that is that the market usually does find a way to background cattle, and feed costs are cheap. And I'm not going to go through all these numbers, but just call your attention on the top that we do have a budget on the webpage that, again, I just threw in some average numbers here, but you put your own numbers in there. But just, kind of as a guide there, I put in beginning value of $430 on some 550 steers and take them out at expected market price there at the beginning of March or so at 360. Again, the futures are 365 today, and we have a positive basis. And and then the feed prices I used are at the bottom of the page there with a little over $1 a ration cost per day. But it does, my bottom line circle in blue there does show like there is potential for backgrounding calves, even though they're high, because of the feeder cattle prices are high too. I did put in, when we have these high prices, of course, LRP costs are high too because of the high value. So I even put in 116.11 for an LRP contract. And so there is a chance for volatility, and yeah, things can happen, and I don't think the Mexican border opening would have the big, huge impact that the futures market sometimes think it will. But we'd add on another 25,000 calves eventually, and some of those things could affect the market. And so for these margin businesses, you're putting record high cattle in, and so maybe you could look at some protection, and the LRP is open. And so this was yesterday's. Yesterday the March futures closed at 360.12, and the offering there was right at about the futures at 360. But again, the premium there is 1366 a hundredweight. So 8 times 5, you get up there into that $116. So I know that's a lot of money for producers to part with, or anyone to part with, even though the prices are high. And so, the other thing is, you can go back here and look at at least for my numbers here, we had a break-even price of about 334. So yeah, you don't buy insurance hoping we're going to collect. We use it as a floor price to protect from a catastrophic price movement, so we can move down the line there if you think, maybe particularly if you don't or can't lose money and have a tight situation depending on different people's equity. So you could go down and cheapen those up as well with some lower premiums. But anyway, LRP is still operating. The offering today is likely going to be, the futures is up $5, so they're probably going to, have a $5, $4 to $5 increase. I guess the October was up 450, so likely, a $4 higher offering again today. And so just end up with lamb prices. Lamb prices again are doing very, very well. Very strong, good demand for domestic lambs, and imports are down a little bit. Cold storage stocks are down significantly of lamb and mutton in cold storage, which says that lamb is moving. And so lamb prices do usually fall this time of the year, and have not shown that yet, as at least of last week, have been holding in there, up there around 240 or so. And on down at the bottom, you see there's the Wisconsin tele-auction that the Tappan wool pool goes through, and sold a load of lambs there, 340 lambs, 140 pounds at 244.50. So lamb prices hanging in there very well too. So with that, I'll quit sharing and turn it over to Dave.
Just a few comments about some things going on in the biofuel market. First, kind of maybe trivial to us, but the Energy Information Administration, which is a federal agency that collects and shares a variety of data for the energy industry, is still up and running, is continuing to maintain their website, collect data, and make publications, in contrast to what's happening with USDA and NAS. An article shared by Brian this morning, and I think I'm going to touch on a couple of things that kind of come back to this, but a report out from the KC Fed referring to the importance of policy in biofuels, and especially for driving future growth. And I think this is generally understood. Right now, we have declining gasoline use, declining transportation fuel use domestically, some opportunities for export. And I'll talk a little bit more about that in a little bit. But domestically, it's really in what ways can we increase biofuel use? We've seen that in California with renewable diesel, biodiesel, and ethanol to some extent with the low carbon fuel standard. But going forward, that type of support is really what's expected to be needed to drive that increased use. And that would possibly be with the RFS. We had those higher renewable volume obligations proposed in June for 26 and 27, essentially, which would provide that floor for biodiesel, renewable diesel use. If that came to be, we would use more vegetable oil. There's a possibility that those numbers may be finalized at a lower level, or there might be other things to erode that decision. Really interesting article came out, or the discussion that came out the last couple of days. There is a new pipeline in Nebraska that is operational. It's Tallgrass Trailblazer. It's a converted natural gas pipeline that now moves CO2 from the Nebraska corn ethanol refineries to Wyoming to the geology where it can be stored. It does a couple of things. One, it may generate 45Z tax credits. It could also generate 45Q tax credits for carbon capture and use, again, meeting the requirements of those policies. It also reduces the carbon footprint of the ethanol produced at the refineries where the CO2 is captured. That is a valuable trait if you export into those states or provinces, nations with low carbon fuel standards or other mechanisms to incentivize that. And the story, and again, it says Cornhuskers, so thought that was interesting that the term was used, brought up by the Iowa Renewable Fuels Association's executive director, who pointed out the disadvantage to the state of Iowa, to their ethanol industry resulting from this. Again, because essentially you're going to have, and I've talked about this before, kind of haves and have-nots in this carbon space. And so in this case, those Nebraska corn ethanol refineries are going to generate additional revenue and be in a likely a better position, first of all, than they would have been otherwise, and relative to those Iowa refineries. Question I get, is that necessarily going to come back to a premium for corn for those farmers in Nebraska? Not necessarily, but it does mean that they have a stronger local customer, which can be really, really valuable. And again, we have some parallels. You know, we have the Summit Pipeline project, which is being retooled, revisited. You know, that would move CO2 from Iowa, Minnesota, South Dakota, North Dakota to storage in North Dakota. But here we have that story about this pipeline in Nebraska. Also, an interesting story that's come around. State of California now allows the use of E15. They had a state level policy that prohibited that. California is unique. Their California Air Resources Board and their action in the clean air regulation space precedes that of the creation of EPA and the Clean Air Act and all that federal activity, so they can make their own rules. They are allowing this use while additional studies being done to see how E15 would work in terms of emissions and so forth. But, you know, work has been done by a variety of folks. By having E15 available, it would drive down prices. You know, it's primarily because you're going to displace relatively expensive gasoline blend stock with that additional ethanol. And of course, too, ethanol plays an important role with low carbon fuel standard in California, you know, to provide that lower carbon fuel for use. It's also going to have this, you know, additional incentive, this value to meet that. And it's important to note too, California, basically all of the ethanol sold, all the gasoline sold in California is E10 for all intents and purposes. And that's also the same for some other Western states. So again, if we already have this push, and again, this additional incentive in terms of having this lower carbon E15, you know, I would expect that we're going to see growth, significant sales of E15 in the state of California, which does bolster the industry. And it goes back to that Fed report, again, biofuel policy supporting that increase in demand and use. And then here's an example, in this case, from the state. The last thing I'm going to cover today is a story. It's actually another story related to this with ethanol in Indonesia. But, you know, Indonesia is looking to have a B50 mandate beginning next year. Indonesia is a unique nation. It's very much a rapidly industrializing, growing country. They do not have petroleum resources, but they have significant ag resources, especially in their ability to produce palm and palm oil. They generally don't, they control and manage palm oil as a resource in part because of its energy value. And so here you see this B50 mandate. And again, this would be significant. It's also important to note too that, you know, in much of the world outside of the United States, outside of the West, folks drive a whole lot less. The number of vehicles, owning a vehicle is a luxury. You know, trips, year-round vehicle miles are very, very low. But this is substantial. That B50 level is significant. With that, thinking about biodiesel and use, there's some considerations with using it or at higher blends. But from a use or a combustion standpoint, it certainly works. And here it's both an economic issue, but also an energy security issue, which is something to note. That's the end of my comments and the comments for all of us. We will be meeting again in a little over a month on November 13th. But I'm happy to facilitate any questions or comments, and we'll see if there's any. There's not any yet. I was wondering if anybody has an additional comment or any thoughts that came by as they were making their remarks. You got it all out. I do think it's interesting that the EIA is operating and NAS isn't.
I wasn't aware of that either. But that is very interesting.
Yep, and they're both very, very important agencies. I mean, having information about agriculture is very valuable, and it's more than it's more passing interest, and it's more than just the functioning of the market. I mean, it goes back to the food security issue. But yeah, kind of a piece of trivia. And today's webinar, we'll be back next month. I want to thank the presenters for being here and those who were able to attend for being able to make it. Thanks.